Hello and welcome to ICICI Bank. I look after investments for private banking and wealth customers. I have with me today Mr. B. Prasanna, who is the group executive and he heads the treasury functions, global markets treasury function, as well as the proprietary trading desk of the bank. I also have with me Mr. Pankaj Pandey, who heads research, equity research for ICICI Direct. Both of them have been, so Prasanna has been there with the bank for more than 30 years, ICICI Group. Pankaj has been there with the group for more than 30 years, 20 years, and myself more than 22 years or so. So, Prasanna, maybe I can start with you and come first to the key burning issues that investors are facing globally as well as in India. There have been significant amount of outflows that have happened since late September, early October until end September. Things were looking like they are going one way. Since then there has been a sharp reversal. Your view, is there something structural which has changed, or is it more of a technical issue that we are facing?
Yeah, so good afternoon and good morning to all the people who have logged in and welcome to this webinar. Yes, Nilesh, like you said, I think markets have a way of teaching all of us lessons and not to get complacent, and things do change substantially in many times. So now, I think to answer your question more specifically, I think outflows from the market, from the Indian equity markets, if we have to talk about, have been driven primarily by a few factors. Like I think the whole thing started when China stimulus was announced in September, which then led in, inflows into China and outflows from a few emerging markets, which included India. Most importantly, after that, the US elections, or rather the run up to the US elections, where the Trump trade started playing effect. We can talk about it in detail as to how that benefits the US more than the rest of the world. And then that led to a change in the view on the Fed as well. Bear in mind that we had a view that the Fed will cut and there will be an 18-month sweet spot for the emerging markets. And that kind of changed when a Trump election happened. Along with these two developments on the global side, you also had weak corporate earnings seasons for quarter two, and also a number of high frequency indicators on the macro side, which also started slowing down, leading to, for the first time after maybe 2, 3 years, analysts starting to downgrade earnings of corporates for the first time, and or reduce the kind of upgrades that they have been having. So I think these are all the main reasons, along with valuations being on the higher side, and of course that was one of the big reasons, and people voted with their feet. Now, if you have to look at going beyond some of these reasons, there are three or four macro factors also, which is kind of I would say turned around a little. The first is, of course, growth. I alluded to the fact that high frequency indicators had started coming lower. Yesterday, we had the proof when the quarter two GDP data came out, and it was a shocker. I'm telling you, Nilesh, I mean, I remember what Dr. Reddy had to say. He said that forecasting is a really tough job, especially when it comes to past data. And that's what this is. I mean, nobody expected GDP data to come to 5.4%. We did know that high frequency indicators were slowing down. We did know that the number will be much lower than the 7% that the Reserve Bank was expecting. But none of us expected 5.4%. And if you have to look at some of the key reasons as to why it was happening, I think there has been a slowdown. I mean, most of the people know about government spending not happening, rainfall being very high, so led to some kind of a consumption slowdown and all that. And I think beyond that, I think what we need to think about is the fact that there are certain slightly longer term factors which could have played, like say a post COVID pent up demand which was building up. Maybe that has slowed down. I'm not saying it's reversing, but it's definitely slowed down from the second derivative perspective. And also the fact that the RBI liquidity tightening and the macro prudential squeezing of some sectors that they had done might also have been the reason. Now, having said all this, we do feel that it's probably the bottom, and we do feel that second half the GDP numbers are going to increase. But if you have to tell the reason as to why the outflows happened, it is because of the fact that the growth was coming lower. And add to that, the second macro which turned a little against was the inflation, which was actually behaving quite well between 4% and 5%. And in the last two readings, we saw it galloping beyond 5%. And the most recent reading, in fact, even crossed 6%, which is the upper threshold of the RBI's tolerance limit. So I think you have a situation where you have a slowing growth and a higher inflation, which is technically a very bad, macro combination. Here also, we actually believe that the outlook is far better than what we saw. And we do feel that the inflation will come down lower as we go forward. The third macro was, of course, the external sector. One of the areas on which the India's balance sheet was bulletproofing, if I have to speak in that term, was the fact that the external sector was very, very comfortable with a BOP in excess of $40-50 billion. That was the estimate that we had for FY25 when we started the year. And gradually, as the year progressed, we have been, downward revising that number. It came down to around $35-40 billion. Now we are seriously looking in the region of $20-30 billion, and not least because of the same outflows that you spoke about. So it's a kind of circular reference, but the fact that India's BOP situation and the fact that money is going back to the mother market, which is the United States, with the US dollar being so strong and the US asset classes being so strong, money being taken out is one of the reasons why FPI outflows are happening. And that itself means, the external situation is turning a little bit negative. And the last, factor I would say is the fact that what does all this combination do to the monetary side? So there was a feeling that you would start seeing a rate cut from the Reserve Bank very soon. And because of all these factors like the external account, the FPI outflows, as well as, the inflation going up, I think there were doubts about when the RBI, definitely it was a delayed rate cutting cycle, at least prior to the yesterday's GDP growth. We can talk about the implication of yesterday's number later on. But I think the view from the market was that the rate cut is possibly going to come either in February or April. And so what was a positive earlier was not as positive for India from that perspective. So all in all, it's a mix of a weakening short-term macros and a valuation which has always been on the higher side, which kind of triggered this correction. And like I said very briefly, most of these factors we feel is probably going to get better as we go forward. We can discuss all these things when we have time. Back to you, Nilesh.
Yeah, thank you. Useful perspective, Prasanna. Pankaj, maybe I'll continue with the same, and I think I'll add one important question that has come up from our clients, those who have logged in. Is the correction over? And maybe you can add to your perspective to what Prasanna said, and maybe conclude whether the correction is over or not.
So, Nilesh, before that, a warm welcome to all for to this webinar. Now, from a correction perspective, since 2007, we have seen Nifty, which is a large cap index, correcting by 10 to say 15 odd percent every year. Mid cap has the tendency to correct even more higher at 15 to 25%. And small cap actually corrects even more with an overall correction range of say 20 to 30 odd percent. And this has been the case since 2007, except for years when you had COVID, when the correction was steeper, or year 2008 when you had the financial crisis. Now, up till now, what we have seen in terms of correction is about 12 odd percent. So our sense is that correction is largely over. And there are some reasons I would want to sort of highlight for the same. So, for example, I think one of the key worries for the market, while Prasanna highlighted a number of things, is the weak corporate earnings in the second quarter. Now, see, the overall expectation of earnings for this year is about 12% and about 15-16% a year after, which is FY26. Now, this particular quarter, when we see overall top line growth for a large cap index like, say, Nifty was 6%. The bottom line growth was 3%. So obviously, the growth was quite lower than the overall growth anticipated. But I think this is one of a quarter because of certain factors. So within this Nifty, if you look at overall, 1/3 of your earnings is, or 30% of the earnings is coming from oil and gas as a sector. Now, because of Chinese slowdown, what we have seen is that the gross refining margins, which were $15-16 per barrel last year, has come down to about $2 to $3 per barrel. So this is one sector which where the earnings corrected by about 27 odd percent. And if I sort of strip out this sector from the overall earning perspective, then what we see is a 6% kind of a top line growth and about 10% kind of a bottom line growth. So not really far off from the overall projected set of numbers. And on top of it, I think this quarter was also impacted by a couple of other factors. So, for example, when we look at, we had an election this year, and then post that the budget got passed somewhere about mid of August. And then on top of it, we had a very extended monsoon. So what it did for a sector like, say, cement. So cement usually for a sector like cement, second quarter is usually weak. Or for the corporate spending or the government spending, usually second quarter is weak, because understand this, if I have to dissect the demand of cement, now 65% of the cement demand comes from housing and 35% comes from the government capex. So from that perspective, if you look at the government, the budget got passed in mid-May, mid-August, and from there on, the overall monsoon sort of impacted the overall consumption. So if your one third of the demand gets impacted, then obviously it has implication, and which is why we have seen that the cement prices are at a 1-year low. And since we are seeing Chinese slowdown, so GRMs are down, and that has impacted even a big sector like steel. So steel prices are at a 3-year low, largely because of the kind of dumping which is going on from a big country, a big exporter like China. Now, our sense is that some of these earnings are at one extreme, and things are going to sort of normalize. Now, coming specifically to the capital expenditure as a segment side. So, what has happened in terms of capex is, see, last year the overall capital expenditure was about 10 lakh crore, and what government achieved was somewhere about 95%. So, this year the overall target is about 11 lakh crore, and overall expectation is that the government would be achieving a similar kind of a number. Now, first 6 months, the overall ordering tendering was about 60,000 crores per month. But good part is that in the October, it picked up to about 1,10,000 odd. So our sense is in the second half, things will sort of become a lot more better. Now, in case if this were not to happen, there will be some impact on the earnings, and that could be in the range of 4 to 5 odd percent. And we have already seen a 12% kind of a correction. So from that perspective, I think overall best or worst of these times are already behind us. The other aspect is that we had US elections, and we all know that there is a good chance that the corporate tax cut is going to happen in US. And US markets have started to do very well, and largely because the money is going to flow there. So obviously, when you get a tax cut, it improves the overall earnings of the companies there. And which is why, from a liquidity perspective, US election is a bit negative for us, and which is what we are seeing. I mean, we have seen an outflow of nearly 1.15 lakh crores in the month of October. This particular week or last week has been relatively better. Even November also has seen a good amount of outflows to the tune of about 30,000 odd crores. So I think outflow-wise it is negative, but I think overall earnings-wise, I think this is one of a quarter, and second half is where we would expect to pick up things to sort of pick up. Now, on a valuation perspective, even if we sort of take a 5% kind of a cut, assuming that the second half capital expenditure does not pick up on the expected lines, even then we feel that overall in the next 2 years you will have earning growth of about 14 odd percent, and which is why a nifty target of 27,500 can be maintained. Now, when we look at valuation, we also need to understand historically how the composition of the index is also changing. Now, when you get stocks, I'm just using as an example, say for example, Trent, which has got a P multiple of say 200 plus, and what you sort of exclude is under 20 P multiple kind of a stock. Naturally, your the P multiples of the index is going to go up, and with the kind of changes further expected, so historical comparison of P multiples with current multiples may not really make a great sense. But having said that, yes, the second quarter was muted, but I think the second half is expected to be a lot more better, and we are keeping our fingers crossed.
Keeping fingers crossed, but both of you are clearly indicating that maybe there was a one-off, and things are likely to mean the word up and we go back to trend quite likely. Staying on with the macro perspective and post Trump election, the biggest global uncertainty persona that has cropped up is what happens post tariffs are introduced. So, few questions. What kind of view do you expect Mr. Trump is going to have with respect to tariffs? Are tariffs going to be there or not? To what extent? What impact do you think it can have on India? And if, as is widely expected, if tariffs are imposed on China big time and therefore yuan depreciates, Chinese currency depreciates, can it have a consequent impact on Indian rupee as well?
Yeah, sorry. So, yeah, Nilesh, what I was saying is that I think the question that you asked is the primary question that all of us are trying to battle and try to figure out what is the right answer for that. And bear in mind, it is not just Trump's tariff policy, but also a number of policies. Let me just briefly, explain. So, by the way, I kind of agree with what Pankaj said that US is clearly the best market to be in the short term, not least also because of not just because of the Trump's policy, but also because of the kind of animal spirits that prevail there. And whenever some sense of an opportunity comes in, a market just goes for the jugular there. And some of the policies, however, that are expected from Trump are actually trade contractionary and inflation positive. And if not for the reserve currency status for the US dollar, I'm sure any other country which would have been following a similar such policy would have actually seen a depreciation and a negative view on the country. But of course, US being US, that's not the case. But let me just talk about the policy agenda of Trump. I think it's built on four broad things, not just tariffs. First is, of course, tariff. The second is fiscal expansion, both through expenditure as well as through tax cuts. I think Pankaj alluded to that. The third is the anti-immigration drive. And the fourth is the deregulation. And deregulation is also something that is extremely important, which is giving rise to a lot of bullishness of US equities. Now, all of these factors are actually US growth positive, but they're not necessarily positive for a world economy aggregate growth. What it means is that there is going to be redistribution of growth away from a few other countries into the US, even assuming that the aggregate growth of the world remains constant or maybe even lower because tariffs can lead to contraction a little bit. Now, getting into each one of them, when you talk about tariffs, you're obviously going to be fearful about trade wars. Now, even before assuming office, the president elect has kind of announced higher tariffs on Mexico, Canada, and additional tariff of 10% on China. And then, of course, there is enough public material that he's going to do 60% on China when he comes into presidency. Now, all of this will impact not only China, Mexico, and Canada, but also the Eurozone. And as much as 50% of US imports happen from these areas. So it will impact US consumer also negatively because the inflation will rise. And overall, when you see resurgence of this kind of a trade war, will result in risk aversion, which might actually weigh on emerging markets, emerging assets, and hence it supports the US dollar. Typically, the US dollar does well either when growth is super good or when growth is super bad, and not when there is a middling growth. What we had painted a scenario around a month ago was a middling growth in the US and all other countries also doing well because Fed rate cuts had started. But unfortunately, now we are getting into a territory where it's going to be a super US kind of a scenario, and that is the reason why money is flowing back. The second most important policy is immigration. I think here it's not very clear. I mean, immigration can lead to higher inflation and can actually lead to a little bit of growth destruction. And so something that these immigrants have actually played a very important part in the growth that US has achieved, even when interest rates were high. So we need to watch that space very closely. The third, of course, is a fiscal policy. Reducing taxes was a very pivotal campaign. And imagine that when you are going to extend the tax cuts that are already in vogue till 25, you're going to extend it beyond 25. And not only that, for incremental domestic manufacturers, you're going to reduce the tax rates from 21% to 15%. That basically means that the EPS and the ROE of all these listed corporates in the US is going to go up. And that will lead to a lot of animal spirits and money chasing these kind of equities. And also the fact that what this will lead to is to release a lot of increase in public debt by the US government over the next decade, and this will likely actually lead to a lot of increase in fiscal deficit to GDP ratio, actually averaging 7.5%, and even public debt to GDP crossing 140%. Now, all of this is possible only because the US is a reserve currency, like I said. And the last policy that on which his entire philosophy is based on is deregulation. And when you say deregulation, think about not just cryptos, but also think about lesser rules on the banking sector, more ability for companies to do M&A activity, more less antitrust kind of litigations, and so on and so forth. So all of that are extremely positive from a business and the equity perspective. Yes, of course, less regulation means at some point of time a return of GFC kind of a crisis will happen, but that's a problem for the future. We don't need to, I guess, worry about it in the next 1 or 2 years, for which the going is going to be very good as far as the US is concerned. Now, if you have to talk about the impact on India very quickly, I think, first of all, I would say that the impact on India, more a direct impact on India is much more limited, since our exports to the US are very small when compared to other countries like Mexico, Canada, China, and all. And similarly, India's exports itself is only around one-fifth of India's GDP. We are primarily a domestic consumption-driven, domestic investment-driven economy. So, to that extent, what happens in the rest of the globe has only to that extent an impact on the 20% of our the 20% of our GDP, which is typically exported. But along the structural drivers, actually puts India in a lot of strength when you look at financial sector, balance sheets are clean, capital is more than adequate, and so on and so forth. And also, one more factor from Trump is the fact that he is actually has a policy of drill, which basically means lower oil prices, which could again benefit India. So I think most of the direct impact is not so great or can be positive. India's, like you rightly asked, Nilesh, I think the exact reason or the primary reason why India will be affected is through the exchange rate route, as there will be a depreciation of the yuan. So when it comes to view on INR, I think the way to look at it would be to say that uh, uh, we had a appreciating bias for the rupee, or at least we had a view that rupee will not depreciate as much as what is priced into the forwards market, which already always prices in a depreciation to the extent of the interest rate differential. So we thought rupee will not depreciate as much, so it will be better than that. But what we now tend to think is that it's quite possible that depreciation can be the norm, primarily because of you don't know what's going to happen to yuan. And obviously, when a tariffs of 60% is imposed on a country like China, you have to expect retaliation, and they will retaliate by their own tariffs on US imports. They will also possibly devalue the currency, their own currency. And last time around, when there was a trade war, there was a not less than 10% devaluation of yuan. So if yuan were to depreciate by something between, let's say, 5 to 10%, and if rupee does not depreciate, then obviously our export competitiveness really goes for a toss. And bear in mind also that the entire emerging market basket will be affected by this yuan depreciation. So when entire country around you is depreciating, it's very difficult for the RBI to keep the rupee under check. In fact, I feel the RBI might be favorably inclined to let the rupee depreciate a little, maybe not to the extent yuan or any other emerging market currency depreciates, but definitely RBI's intervention policy, which has been at least till a month ago was to keep the rupee really strong, will actually lead. They will ensure some orderly pace of depreciation as we go forward. In the last 1 month, 1.5 months, RBI has already used up close to um, uh, 35 to $40 billion of reserves in the spot and the onshore forward market. And over and above that, they are also short the NDF market. So bear in mind that the RBI is already doing a lot to prevent the rupee from depreciating as much as what the market forces would have taken it to when the Trump trade started globally. I think I'll stop there. Give it back to you, Nilesh.
Yeah, thanks. So understood. Pankaj, maybe quickly, if you can talk about how is corporate India preparing itself for the likely Trump tariff risk? Will India be a likely beneficiary from a corporate sector perspective? This whole China plus one, can this whole trend accelerate? What do you think?
So, Nilesh, I think there are a couple of things which I would want to highlight. One is when the US market looks attractive because of corporate tax cut, and usually the liquidity sort of flows to the US market, and we have already seen FIs selling in the Indian markets. The one sector which gets impacted the most is the banking and financial services sector. I think this is one sector where the FI exposure has been the highest. And whatever of late selling we have seen, BFSI gets impacted. So indirectly, this is one sector which gets impacted. Now, coming to other sectors, so for example, IT overall with US elections over there and with potential tax cut. Now, what we get a feeler from the customer is that going forward, there could be a potential revival in the discretionary spend, especially in key sectors like, say, banking there, retail, telecom. And obviously, so this is positive for IT because overall, while things have not really been great for IT up till now, but things are expected to become better for IT. So FY25, what we sense is that you could see a mid-single digit kind of a growth. FY26 is where you will see the benefit of this higher discretionary spending, which will come up. But not everything is positive for IT because what you also sort of get to hear is that one, there could be concerns on the visa availability. Then obviously, it is very much possible that or companies are fearing that on offshoring would be happening more. Sorry, onshoring would be happening more, and from that perspective, obviously, it entails higher cost. But sum total with the overall deal ramp up, it is positive for IT companies or expected to be positive for IT company. Then I think defense is another sector which we don't talk much, but yes, Indian defense sector can benefit in terms of better military ties. And we already have a lot of US made equipment and going forward also as well, potentially a lot of deals can be possible because US obviously has a lot of technologies, whether it is electromagnetic aircraft launch system, which is required for aircraft carriers, or we require engines for our four and a half generation or fifth generation aircrafts. The other sector where we are clearly seeing the inquiries have gone up because of China plus one factor also is the pharma sector. So overall sense is that the Biosecure Act there is going to become a legislation because I think once it is cleared by US Senate, and which does not look like a challenge. So once this becomes an act, what it does is that it prevents Chinese leading CRAMS or contract manufacturing companies from accessing US funding and also collaborating with pharma companies there. But this legislation is essentially sort of designed to prevent Chinese CDMOs from one because of the fear that they might steal or they might steal the IP, or also because of the perspective that they might sort of tinker with the US citizen genetic codes. So as a result of that, India is expected to be a big beneficiary. And mind you, the entire CDMO companies. Actually, the top line is far more lower than some of the players which China has. So from that perspective, the potential opportunity is pretty large there. So we'll not be surprised if we see a lot more positive things. And coming to some of the other sectors, so for example, auto, engineering, textile. Now, overall sense is that the tariff for big exporters like China is obviously going to be higher, and for a country like India is expected to be relatively lower. So obviously there'll be a tariff arbitrage which will get created and which is positive for some of these sectors or companies which are exporting here, especially in auto, engineering, textile, to name a few. So I think overall net liquidity is negative, but it is positive for the sectors which I just spoke about.
Okay, so clearly many likely beneficiaries from this whole likely tariff issue. Uh, we are 30 minutes into the conversation. Maybe over next 10-15 minutes, we'll try and kind of quickly pack in as much as we can. Prasanna, over to you and quick view on how should an non-resident investor look at India. What opportunities do you see in India for those guys, for NRIs? And especially what should be an ideal allocation towards India and which asset classes?
Okay. So, I mean, ideal asset allocation is something I think will probably be each person will have his own risk return profile. Really difficult to generalize. But I can say one thing: because of NRIs investing from outside, they have the ability to move across markets, which is something which is not very prevalent amongst Indians, and Indians predominantly invest in Indian asset classes. But nevertheless, I think when you look at the international markets of where all where asset classes are going to be, now when you look at global, domestic bonds, there is going to be considerable divergence in the global rates market. Because that reflect the differences in both the cyclical outlook as well as the central bank responses. The prospect of expansionary fiscal policy, higher inflation, all of this are going to ensure that the Fed is going to cut much less than what they were going to cut earlier, and hence there's going to be a higher terminal rate in the US. So US sovereign yields hence should actually see an upward bias. We had all changed our view on the US bonds being very attractive when it was around 425 and the Fed was going to cut, and it reached 360. But after that, yields have gone up by 75 basis points when Fed has actually cut by 75 basis points, and that is the impact of the Trump trade. And for all the reasons we spoke about, we expect US yields, especially the 2-year, to be in the 425 to 445 range till end of the year, this calendar year, and the 10-year to be between, say, 430 to 450. So kind of upward bias there. And going after, basically, as we go into 2025, I think there is a scope for a steepening bias, because as we go forward, the risk of supply hitting the longer end is going to get higher and higher as Trump implements his policy. So 10-year yield might not fall or might actually go up, whereas the short end can actually come down. So the 2-year, 3-year US treasuries could actually come down in yields, primarily because of the Fed cut, because whatever it is, they will cut maybe 2 times or 3 times next year. We also see Eurozone yields moving sharply lower because there is a greater buildup of disinflation there as well. And also the fact that Europe is one of the worst affected areas on account of the US geopolitics and tariffs. We don't think UK sovereign yields trade, which are much more kind of modest downtrend. Chinese yields could actually drop a little bit more. JPY yields can actually rise because that reflects the Bank of Japan's normalization plan. So when you come to India, so Indian yields have not actually reacted as much as what US yields have reacted, and that's because of the structural factors, financialization of savings, which not only helps the equity market, also impacts and helps the bond markets, money coming into insurance companies and insurance companies buying bonds. And also the fact that there has been a bond index inclusion this year, nearly $20 billion of passive money has come into the Indian bond markets. And the fact that the government is actually consolidating on the fiscal deficit side, borrowing less rather than borrowing more like the US government. And government has recently also cut its T-bill borrowing. So we expect the 10-year benchmark to kind of trade in a range of 665 to 680 till March 2025. But there is a downward bias after yesterday's quarter 2 GDP data, because that opens up the possibility of what will RBI do. Maybe we have time, we can discuss about it later. Short-end rates in India can possibly, see more easing, because even if RBI is not able to cut rates immediately in December, they will be looking to infuse liquidity by either a CRR cut or through other means. So that will, favorably impact the short end of the Indian bond market. US equity markets, I think all of us have spoken how attractive it's going to be with rotation of funds into the US. A lot of it has played out. Probably it will still keep playing till January when the announcement happens, and after that it will be a kind of a sell on news, buy on rumor kind of a trade. Indian equities, of course, Pankaj is a master, is given a very clear direction that we are kind of bottomed out on that. But I will just say that from a structural factors, I would say that the trade in the last 1 month or 1.5 months is a short-term tactical kind of a bearish trade that is playing out in India. And we all knew that the valuation was a problem, and hence we needed excuses for it to correct, and we got the excuse globally as well as on the domestic side when the growth slowed. But bear in mind that none of the structural factors which are driving India's growth story has weakened one bit. If you look at population, the demographics, we are not only going to be the largest population, we are going to be the youngest population. We're going to be the country with the maximum number of working population, and with a median age which is even just 28 years, at good 10 years less than US and China. and that is going to remain the youngest even 10 years down the line. And then some of the other things are the female participation increasing. That is also leading to higher growth. India is, of course, you would know, has doubled the number of airports, national highways, metro trains in number of cities, more than 17, 18 cities, faster trains, making it more productive. Hotel occupancy, Indians are driving and also traveling and taking air flights to domestic destinations. Recent data shows international tourism has also started increasing. So some of those structural factors will, continue. And also the power sector, which maybe Pankaj will talk about, but something that where the renewable power as well as thermal power are both driving India's growth in manufacturing. So a lot of tailwinds are there as far as India's growth on the equity side is concerned. I would say a mix of all kinds of assets is what a reasonable good mix based on the risk return profile of the individual investor is what one would need to look at when you look at investing across asset classes across the globe.
So I take three quick takeaways from this. One, since interest rates have peaked out in India, so therefore there is an opportunity for one to lock in yields in India through deposits and otherwise. Maybe an FCNR deposit could be a good pick at this point in time so that you are not, and an NRE deposit where maybe yields have kind of peaked out. You also spoke about the fact that the near term has been one off and therefore there are enough and more long-term drivers from an equity perspective. So clearly, Pankaj, while you spoke about the maybe near-term opportunities for corporate sector, if one has to take a 5 and a 10-year view, what are the things that one can kind of, and since we have, like Prasanna said, that this valuation has come down, higher valuations can come down because of this correction. If on Monday somebody has to go on ICICI Direct and kind of put in a trade, what are those 3 or 4 things you think one can kind of do on Monday from a 5 to 10 year perspective?
So Nilesh, so largely if you look at from a say 5 or 10 year perspective, typically capital expenditure is at the top of the league because last 4 or 5 years we have seen capital expenditure growing at about 25% CAGR, and with capex as a percentage of GDP at a lifetime high of 3.4%. And there is no iota of doubt also in terms of these capex not being maintained as a percentage to GDP. So from that perspective, this is one of the biggest themes which is playing out. So obviously in that you have the entire capital goods, the infrastructure beneficiaries, cement, and I would not really sort of put steel in the same basket, though it's a sort of a basic sector, largely because, like I said, this is one sector which is experiencing a 3 year low in the prices, and because of the fact that China has been sort of dumping. But rest of the other segments are absolutely fine, and I would want to believe that with these kind of GDP numbers, the potential for rate cut also sort of improves, and infra in general is a very rate sensitive segment. So this is one segment which looks clearly good, and so while infra, cement, capital goods, I think these are the sector. Within that, cement is one sector which is very attractive from a risk reward perspective. So if somebody has to sort of put an order in a sector, then I think it should be cement and infra. Besides that, I think you have structural measures being taken by the government. So banking and financial services clearly looks good. This is one sector from a risk reward perspective, particularly looks attractive. And also structurally also because the borrower behavior has definitely changed post implementation of IBC now. And I think power is another sector which is part of the overall energy transition beneficiaries. And besides that, auto is there and power. So of the overall capex or capital expenditure which is going on, the maximum capital expenditure is happening in a sector like power. So, for example, what we are looking to do is that increase the India share of renewables, say from 41% to about 60% by 2030. Now, this itself is going to entail a capex of 25 to 30 lakh crore. And mind you, overall capex, what the government does is about 11 lakh crores for this year, and 10 lakh crore was the number a year before. And power becomes extremely crucial because one, the power sector itself is transitioning. The other is that when you look at auto sector, off late you would have noticed a couple of launches both on the two-wheeler side as also on the four-wheeler side, and pretty interesting. So I think India is going to benefit from two aspects. One, the higher level of EV penetration, and also the premiumization which is going on. So I think this is another sector which looks very good. Now, I'm not really a great fan of consumption, but if I have to sort of highlight two segments, one, I think even Prasanna sort of highlighted. Foreign tourist arrivals have been improving, plus the domestic tourists have also been sort of doing very well. So I think hospitality as a sector looks very attractive. And in the similar breath, I think hospitals are also doing very well because we have a very fairly large market and a pretty quite a significant amount of under penetration which is there in the hospital as a segment. So that is another segment which is looking structurally very positive. So I think it should be a combination of capital or capex beneficiaries. It could be capital goods plus infrastructure. Cement is what one can look at. Risk reward wise, banking. And on the consumption side, obviously, you have segments like, say, hospitals and hotels, which look attractive. So a combination of these is what I would sort of suggest to sort of create a portfolio if someone is looking for the next 5 to 10 years.
Okay, so a good spread over there. I'll request all our viewers to kind of dial up their equity advisors on Monday and kind of get specific choices that they would want to have on a lighter note. Maybe, Prasanna, I think since we have spoken about the near-term issues coming from the global perspective, and we've also spoken about high valuations that have already come down. One of the risks was foreign outflows, which has already panned out. There are long-term opportunities, but one thing that we have not discussed is if let's say a month or so, and this is a risk that one can kind of probably say, if for a month, 2 months, FIs continue to kind of pull out money, do you think that the local investor behavior, and we know that flows into Indian equities from local investors have been quite high and they have been ever increasing. We hope that they continue to increase. Could there be a risk to that behavior? And could there be a slowdown in local flows? Is that a risk that one should contend with over next 2 to 3 months perspective, or maybe 6 months?
So I think, Nilesh, that is definitely a risk which we won't be able to, fathom as to when it's going to turn or whether it will turn. Just broadly, two or three things that we can say is it's a fact that financialization of savings has happened on a big time post-COVID, and 3 crore demat account holders are becoming 15 crore demat account holders, and more people are investing into SIPs, and the number just keeps increasing, both not only in number terms but also in the value terms. And it is reaching, and the average size of the SIP is actually coming lower and lower, which means there is a much greater democratization of the equity markets in India. Remember that these are not, you shouldn't look at these as a percentage of the annual GDP or annual yearly income of the population, because to some extent, I think this is payback time. For the last 40 years or 50 years, it was primarily real estate, gold, and fixed income, which was actually getting the benefit of the outstanding savings of the Indian society. And to a lot of extent, what is now happening is payback of that, which is that people are wanting to correct the historical outstanding ratios. So if you have to look at the outstanding, what should I say, the savings of the society, then to that extent, I think there is a lot more space for the savings to continue. Now, if you have to get 2 months, 3 months, 4 months of negative returns every month in the stock market, then it is anybody's guess whether people will have the patience to continue investing in the Indian equity markets. And in a month when they don't invest, but FPIs keep selling, then will the market fall? We'll have to wait and see. But I think otherwise, the trend is here to stay, that it is not going to reverse in a hurry. And the fact that democratization of savings, more people getting into the equity network, getting into the mutual fund network, getting into the SIP, and more people directly investing into equities. It is something that is here to stay. And we'll have to, look at some of the data very closely as we go forward if there are consequent months of, negative returns. But if I hear what Pankaj has to say, which is that more or less the correction is kind of at its fag end, and if that were to be true, and then if market does recover very soon, then you would actually see Indian domestic investors having the last laugh yet again, because FIs have sold when the markets have crashed in the last 2 months, and it's the domestic investors who have increased their investments. So they will be sitting on a pile of money again. So if that was to happen, then you could assume that this trend will actually strengthen going forward.
Okay, yeah. So maybe I'll take a few questions before we wrap up from that we have got from our customers while they've kind of logged in today or earlier. Maybe a quick view, and I'll combining two questions, Prasanna, for you. What role does inflation play in India's economic outlook? And as a consequence to that, what are your views on RBI rates and bond yields in India?
Okay, so the first part is actually a very general kind of a question, and the way I would respond to that is uh, stable inflation is something which is a very important criteria for uh, a capital investor. For him to face a lot of volatility in inflation, it actually discourages investment. So, any country which targets inflation at a very, very meaningful way, formulates policy, and gives the confidence to the investors that inflation is something that will be top of the mind for the central bank and the government to control, gives a very positive signal for people who are actually investing into the country's future. So, because inflation, if it was much higher than budgeted, can eat away all your profits because you earn on a nominal basis, your revenues are on a nominal basis, and when the inflation is going to be higher, you're going to, pay the price for it. So, I think having a stable inflation that's the reason why having a stable inflation, predictable inflation is very important. I would say that India has still not mastered the art of predictable inflation despite a good 8 to 10 years of inflation targeting. Core inflation has kind of become much more stable, much more contained within 4%. But headline inflation has been very volatile because of food inflation. And I think RBI has to some extent been right in targeting overall inflation as a target instead of core inflation for the interest rate setting policy, primarily because of the fact that you need to give savers a positive real rate of return and not just a positive return over core inflation. It has to be over consumption basket that they actually face on a monthly basis. So to that extent, that is important. And also, the common man does not understand core inflation. He understands headline inflation better. He understands food inflation better. So to that extent, ignoring that would be like kind of not a very great thing. Having said that, there is always, a mix of both. So I guess there are a lot of material and a lot of discussions, public discussion that have started on whether we should change the weights of how much food inflation is and how much core inflation is in the entire food inflation basket. So maybe the economists and the government and the RBI will come to a good conclusion on that in order to facilitate better policy making going forward. Now, what was the second part of the question?
RBI rates and bond yields.
Yeah, so I think what has happened is we had a scenario where core inflation was nearly 3% and headline inflation was just at 4.5%, hardly around a couple of months ago. And the rupee was also positive and money was coming into emerging markets. Fed was going to cut rates and all that. Now, unfortunately, a lot of things have happened, which some of which are downright, negative. One is, of course, inflation has gone beyond 6%. Governor has been very, very clear in telling about the 4% inflation target on a sustainable basis, not just touch 4 and then go up, but it has to sustain at 4%. So from that perspective, the minute it crosses 6.2, it makes it very difficult for the RBI to cut rates, though RBI will want to cut rates because of the fact that the GDP growth is now turned around and it's now at the 5% handle. The second thing that has gone around is also the global factors out of which we have discussed a lot. From a situation of emerging market positivity and rupee strength, back to emerging market weakness and rupee and dollar strength. So with that turnaround, it's now uh, difficult for rates to actually fall, because in that case, there will be further weakening of that domestic currency. Having said all this, I think RBI will have to find a middle path. And the way they will find a middle path is possibly, since they already changed their stance to a neutral last policy, they might talk dovish in this policy, giving a clear indication that they are going to probably cut rates going forward, using growth as the primary factor rather than inflation, as long as it's within the tolerance band. Because this is 6.2, but then the next inflation reading is going to be between 5 and 6. So it comes within, and in fact, then towards the last quarter, it goes in the 4 handle as well. So it gives enough space for the RBI to do it. And I think so that's the main thing. But before that, they can also, do measures to infuse liquidity into the banking system, because infusing liquidity, keeping the price of money same at 6.5%, but infusing more money into the market can actually, meet to a little bit more support for the SMEs and the entire businesses of the world, because the banks will be in a better position to lend to them. So I think we are possibly going to see a CRR cut in December. That's our view at this point of time, and a rate cut between February and April. And kind of now leaning towards February. Just before this yesterday's GDP number, I was thinking more in the April time frame. But now I'm leaning more towards February. But of course, global factors will have to play, cannot play spoil sport. They have to play with us. We have to have the dollar having peaked out in its strength by that time. And then, Trump's policies start coming into play. The market Trump trade would have also played its part. If all of that were to happen and food inflation were to revert back as to the way we are thinking, then the situation is ripe for an RBI rate cut on the repo side by February. But before that, we could see more dovish talk, and we could see a CRR cut.
Okay. We are short of time, but I'll just take one or two more questions. Prasanna, what is your view on gold prices before I come to Pankaj?
So I think gold is an asset class which has performed very well over the last 1 to 2 years, and is possibly likely to perform well as we go forward also. One or two reasons for it. One is, typically when interest rates fall, the logic is for gold to appreciate, because the opportunity cost of holding gold comes down. And the second point is, of course, more from a technical perspective, that what started as a de-dollarization move that started around about the time when US imposed sanctions on Russian reserves held in US dollars. I think the move towards de-dollarization picked up a lot at that time. And when you look around, you don't see any single currency capable of taking the entire mantle of being an alternative to the dollar. And hence it was gold which played its part, and it was able to appreciate. That will continue. And not only that, even the central banks of the various countries have started buying gold substantially. So they are now diversifying their reserves away from dollar into more and more of gold. And the fact that domestic demand, both from an investment and a consumption perspective in India, typically increases when gold price falls, which acts as a natural cushion. So net, we do feel that gold prices can continue to, appreciate.
Okay. Pankaj, while we have discussed it briefly, but two questions which I'm combining. Which sectors do you think will have a high government focus on, and which are the sectors apart from capex that you think you will kind of focus on? I think you covered it, but maybe briefly if you can reiterate.
Sure. So one thing which we are clearly looking at is that government capex is set to accelerate in the second half after this muted first half. Because last year, first half, government achieved somewhere about 49% of the overall stated capex. I'm talking of central government. This time around, they achieved only 37%. Now, if I have to come to, say, a specific segment, obviously, you'll have capital expenditure beneficiaries. So you'll have segments like, say, capital goods, infra, cement, which is there. If I have to sort of talk of, say, specific, then so within even capital goods, if you look at Our sense is that you have segments like, say, power transmission and distribution, which again is a sector where a lot of underinvestment is there, not only in India but globally also, and the kind of demand which is coming from the data center. Road is another sector where we see good amount of capex happening, water, building, and factories, EPC. So these are the pockets which are looking attractive besides the typical EPC companies as well. Now, banking looks quite attractive from the perspective that the balance sheets are lean, bad loan provisioning is behind us. Cement looks quite attractive. Steel, probably at a later stage, might become better. At this point of time, risk reward wise, it is still fine. Till the time we don't take some action in terms of the kind of dumping what they are doing, steel probably might remain sideways, and that is post some action by our government. That is when we would expect this sector to sort of do well. Power, I think, overall is one sector which is going to sort of garner the maximum capex, and we all know that India's top two corporates are spending maximum amount of money or capex in this particular sector. And as an offshoot of this, hydrogen is also another sector, a segment within which is going to be anchored by power. So, which is also expected to be in limelight. Then I think one needs to very stock specific. So, for example, in pharma, so there are some segments like I said, hospitals which are looking good, or contract research and manufacturing, or what we call as CRAMS or CDMO, which again will benefit from the passage of US Biosecure Act. And then I think auto is another sector which obviously the premiumization plays definitely playing out, because last 4 5 years, if the average ticket price of the vehicle sold was somewhere about 6.5 lakh, now this is inched up to closer more than 12 lakhs. And largely because of the perspective that people have started to look at more tech in terms of when they buy an auto, and also from that perspective, more of luxury oriented segments or products, like say for example in a auto, the typical requirement for sunroof is becoming standard. Customers want alloy wheels in their vehicle. And then there is a good amount of technology which is going on, which is the level likes of say ADAS level 1 or level 2, or auto park, what you have seen in the recent launches. Now, for that kind of a technology, not the entire technology space looks attractive, but you have companies in the R&D space which cater to a segment like auto, where you have a lot of these tech-oriented products. So again, a lot of things are interconnected. So while I don't like everything in technology, but yes, these are some of the pockets. Clearly, you can see consumers really preferring this, and where we feel that even the tech spends are going to sort of happen. So I think all these segments, cement, pharma, again, hospitals, cram, power sector, auto, IT, again, ER&D players, or if I have to talk of specific segments, road, power, T&D, renewables, water, building, I think these are the pockets where I think things are looking quite attractive. And like I said, second half, we would expect government capex to sort of accelerate.
Okay, so a quick summary of whatever we have discussed and my key takeaways. Don't worry about this recent bout of foreign outflows that perhaps has given an opportunity to invest in Indian equities as valuations have corrected. Pankaj spoke about several areas. I mean, he was just speaking, which offer promise from long-term perspective. Prasanna also highlighted that the structural drivers of India is pretty solid and they can clearly outlast Trump tariffs. There's also an opportunity to lock in deposit yields in India as RBI may start loosening monetary policy as we go forward. Many thanks for taking time out today. Do provide your valuable feedback towards the end of this webinar as you move out. Thank you so much, Prasanna. Thank you so much, Pankaj. Thanks to all the viewers for taking time out.